All right, let's talk Mercantile Bank. Their latest earnings just dropped, and honestly, it's a bit of a mixed bag. They crushed it on profits, but kind of whiffed on revenue. So the big question is, right? Is this a bank that's executing flawlessly, or are we starting to see the first signs of a slowdown? We're going to dig into all of it, the numbers, the strategy, the whole shebang.
So here it is, the main event. You've got the EPS beat on one side and the revenue miss on the other. I mean, they beat expectations, posting $1.40 per share, which is great. But then you look at revenue, and it's just a hair short of what analysts wanted to see. And that right there, that creates this instant tug of war for investors. What do you pay attention to? The solid profit on the bottom line or that little crack in the top line?
And how did the market react to all this? Well, pretty much with a collective shrug. Seriously, the stock barely budged, up less than 1%. That tells you everything you need to know. It says Wall Street is basically sitting on its hands in full-on wait-and-see mode. They're trying to figure out if Mercantile's long-term game plan is strong enough to overlook these immediate little hiccups.
Okay, to really get why everyone's in that wait-and-see mode, we have to go inside the numbers. Let's take a look at what's really driving performance here.
Okay, so you can see that 3-cent beat on EPS pretty clearly, right? $1.40 versus the 137 consensus. But for me, the real story here is the net income. Look at that jump year over year. We're going from 19.6 million up to 22.8 million. That's a really solid pop, and it shows that even with that little revenue miss, the bank's profitability is absolutely moving in the right direction. So you're probably asking, okay, where did that nice earnings beat actually come from? Well, it's all about the bread and butter of banking, net interest income. Think of this as the core engine of the bank, the profit it makes just from lending money out and taking deposits in. And that engine is running strong. It grew a healthy 5.5% compared to last year. When you see that number growing, it's just a fundamental, powerful sign of a healthy bank. And what's fueling that engine? It's this number right here, 3.43%. That's the net interest margin, or NIM. Now, management was all over this on the earnings call. And for good reason. It actually ticked up a little from last year. What that means, in simple terms, is that the money they're making on loans is doing a great job of covering the rising costs of deposits. You know, in this kind of rate environment, that's a huge deal. It's a key sign of resilience, and it really backs up their whole story about solid execution. And it's not just about the income. If you look at the balance sheet, man, this thing is built like a fortress. The CEO spent a good bit of time on this, and you can see why. Their asset quality, pristine. We're talking almost zero bad loans. Their liquidity is way up, and they're bringing in more and more fee income from things like treasury and mortgage services. But here's the kicker. Tangible book value per share is up a whopping 11%. That's a core measure of a bank's actual worth. And seeing that grow so strongly is just fantastic. But look, the last quarter is only half the story. The other half, and you could argue it's the more important half for the stock, is all about their big new acquisition of Eastern Michigan Bank. So you got to ask, why this deal? Why now? Well, it was both strategic and defensive. The number one goal was to get their hands on a ton of stable, low-cost deposits. You see, in the banking world right now, cheap, stable funding is king. It's everything. And this acquisition, it's like filling up the gas tank. It gives Mercantile all the fuel it's going to need to power its loan growth for the next few years. And you know, the CEO, Ray Rizmoth, he was super clear about this on the call. He basically said, look, this is us doing exactly what we said we were going to do. So this isn't some shiny object they got distracted by. No way. This deal is the absolute centerpiece of their entire game plan for growth and stability. And this acquisition completely shapes their outlook for 2026. So what are they telling us to expect? Well, they're guiding for some really solid loan growth, somewhere in the 5 to 7% range. They also think that net interest margin is going to stay stable, maybe even creep up a bit. But, and listen, this is a really big but, they are flagging that expenses are going to be higher for a while as they pour money into this integration. And that expense piece brings us to the headwinds. This is the central debate for anyone looking at the stock right now, the investor tug of war. So this really boils down to the classic bull versus bear debates. It's pretty simple. The bulls are looking at that solid loan growth forecast, the stable margin, and that awesome growth in tangible book value. And they're thinking, yep, this is a disciplined bank that just keeps compounding value. But the bears, they're laser focused on those rising expenses, the fact that the cost savings from the deal are way down the road, and of course that flat stock price we talked about.
And this timeline really spells out why the bears are so cautious. I mean, look at this. The deal closed at the end of 2025, sure, but the real payoff, the cost savings, the synergies, that stuff is way, way down the road. Management made it crystal clear. 2026 is going to be a heavy investment year. The two banks are basically going to operate separately. The big financial win from all this, that's not really hitting the bottom line until 2027. So they're basically asking investors to just hang in there and be patient. And, patience isn't always Wall Street's strong suit.
Okay, so we've hit the numbers, the strategy, and the headwinds. Now let's put it all together and give you our take on what to watch for next. So this is it, the million-dollar question. Where does Mercantile Bank actually go from here? You've got this super solid, fundamentally sound bank making a huge strategic move. But at the same time, you've got these major short-term costs staring you in the face. How on earth do you balance those two things?
Okay, so here's our call. We're rating this a market perform. Look, we think the stock is priced just about right for now. The bank's fundamentals are great, no doubt about it. And their strategic plan, it's clear and compelling. But, and it's that same but again, you just can't ignore the headwinds. The higher expenses and the long wait for synergies in 2026 are real, and they perfectly balance out the positives. So what does that mean? We expect the stock to pretty much just move along with the rest of the regional bank sector for a while.
All right, now for a little something we call a wild yet plausible trade idea. The whole thesis here is what we'd call execution drag. The bet is that the market is just a little too rosy on this whole integration story, and they're really underestimating how much those 2026 expenses are going to sting. So what's the trade? It's a classic pairs trade. You'd go long on a super efficient, well-run regional bank, and you'd short MBWM, heading into the middle of 2026. The catalysts are pretty simple. You watch the next one or two earnings reports. If expenses pop higher than expected, or if that loan growth starts to look a little soft, well, that short could really start to work. What's the target? You'd be looking for MBWM to underperform its peers by maybe 5 to 8% over the next 6 months if these headwinds prove to be a bit stronger than management let on.
And of course, please remember this is not financial advice.